Okay, you've seen the title. Before you start your angry typing, this is not about whether or not we should or shouldn't get student loan forgiveness, nor is it about the politics one side or the other. This is about why we haven't gotten student loan forgiveness yet, why it's very unlikely, and possible scenarios for if it were to happen. And I am not defending anything. This is meant to be a condemnation of the system, not a defense of it. And it is my hope that this will give at least a few people a new perspective of the situation so that you can do your own investigation and planning for possible eventualities. Before we get started, hello, I'm Zyfang. Just Zy is fine. I'm a Chimera and variety game VTuber who happens to have a strong interest in tech and finance. So while games might be the most common subject you'll find from me, don't be surprised when you see videos like this one trying to help and educate people. It's my genuine hope that someone will watch my videos and find them helpful. So if I end up helping just one person, my time here isn't wasted. With that, let's begin. Now, one of the first things that I expect after that intro is some people will probably point out the limited forgiveness that's already happened. However, if you take another look at them, you'll see that though they've been touted as loan forgiveness, in terms of how it's getting paid for, it's the schools themselves being forced to refund loans, or more often their insurance that they bought for this specific purpose. This is bad actors getting caught and having to pay back the money, not loan forgiveness. So, with those out of the way, the first thing we need to cover is what are federal student loans, because what they are in the banking system is a major contributing factor to the problem we're facing. In a lot of discussions, both ones that I've taken part in and ones that I've watched take place, it seems a lot of people think federal student loans are government loans, or at the very least government-owned loans. It is the government that lends the money and is the party owed the payment. This is incorrect. These are private loans from individual banks that the government has co-signed onto to guarantee that if you can't pay, they will. This is why they have reduced rates and more generous payment options compared to your garden variety loans. Because at the end of the day, one way or another, the bank gets their money. This is also why student loans are so difficult to discharge in bankruptcy, and why said discharges typically generate appeals from the Department of Education, because any loans that are defaulted on automatically become the government's problem to deal with and pay off. However, this on its own is just the tip of the iceberg. There's a whole economic labyrinth that's been built on top of these loans as a result of them being packaged into something called Student Loan Asset-Backed Securities, or SLABs. And to understand what these are and how they work, and how they can go wrong, we're going to have to step back into the 2008 financial crisis and what caused it. Mortgage-backed securities, aka MBSs, or mortgage bonds. Now, this is going to be very boiled down, and I won't be using all the full and proper terms according to the official financial, you get the idea. This is a conscious decision to try to keep it from becoming a big bloated mess, because that mess of terms and interactions and intricacies is exactly why banks have built these things as complicated as possible, to keep them bloated messes and bore people out of taking the time to learn how they work. Plus, they keep changing the names to prevent people getting scared off these products. You'll see an example in a sec, but yeah, there's so many different changes that they make that just, even if the name isn't correct, what it is. So, with that disclaimer out of the way, the mortgage-backed security, or MBS. These are packages of mortgages wrapped together by the issuing bank that first gave the mortgages and sold as a security or bond to the financial market. These can then be bought and traded with their value coming from the ongoing interest payments, which cause them to be worth more than just the base loan. For example, if I take out a $100,000 loan at 5% for 25 years, the end result is the total value being just over $175,000. Because of this, an MBS buyer may actually pay more than the initial loan amount, expecting to make a profit in the long run. Thus, a bank gives a mortgage, makes $5,000 in the closing fees, and sells it for, let's say, $110,000. They've made a $15,000 profit and can immediately reissue another loan with that same money. So, all these personal mortgages are collectively packaged into MBSs worth millions and sold as investment assets. These are bought by retirement funds, hedge funds, banks, and many other organizations as ways to store their money and increase its value more than just holding regular cash and getting a percentage point of a percentage point, sometimes of a percentage point, in interest. On its own, while it's clearly opportunistic profiteering, it's not the worst thing they could have done. That's what we're going to talk about next. At first, mortgages were only being given out to people who passed very specific requirements. People with jobs that guaranteed enough income to cover the payments and good credit to prove that they'd be able to keep paying reliably. However, as most of these people got houses and were satisfied with where they were living and weren't quickly reselling to get another bigger mortgage, the buying rate slowed. And banks began getting more and more predatory with their lending, giving loans to people with the promise of being a homeowner only to get sucked into a cycle of debt and bankruptcy trying to make their payments, and who would likely go into, as stated, the bankruptcy and be left unable to pay at all. Banks used these bad loans to pack more MBSs so that they could keep selling for quick profits, as the bank that made them wasn't at risk once they sold them off. They no longer own the mortgage. As people began missing payments, sometimes bonds or pieces of the bonds wouldn't sell and would become junk sitting on their balance sheets. But the banks aren't about to let that stop the money printer. So they repackage them into something called collateralized debt obligations, or CDOs. You see, while a bond that is late or stopped paying out is bad on its own, if you package 1,000 of them together, the regulators now call it diversified, and now it's considered safe again. And the banks just go ahead and sell these and and the profit machine gets going again like nothing happened. And while all of this is going on, Wall Street has its own little unregulated and unlicensed gambling casino riding on this whole thing. Some groups don't want to buy and sell MBSs or CDOs. They prefer more short-term payoffs. So, rather than invest directly, they bet with someone else whether or not the payment will come out on time and at the rate it should. Then other people bet on whether or not the first people will win that bet, and so on. As a result, $1 million in mortgages has $20 million riding on it paying out like it should each month. This sets up a massive set of dominoes all riding on these MBSs and CDOs paying out like they should. And in 2008, we saw what happens when they don't. If the bonds and CDOs don't pay, they drop in value, drastically. Many become outright worthless and unsellable. Plus, they set off all those bets that Wall Street had put together. Because everyone assumed them paying out was a sure thing, you get massive payouts if they didn't, sometimes as high as 20 to 1. But the companies that now have to pay 20 times the bond's value had most of their money in those very bonds and CDOs and bets instead of cash. And now they have to sell them to get the money. The bonds that just failed and dropped in value to the point of being nigh unsellable. At the very least to the point of extreme value loss. So they have to start selling everything else they have to cover their owed debts, including stuff like stocks and business shares. But because so many banks and hedge funds are all in the same boat, most people are selling and almost no one is buying. And no one has the cash to pay out what they owe. So the value of everything tanks all at once, unless we arrive to the financial crisis of 2008. Now, take everything I just told you and apply it to student loans and the slabs that they've been packaged into. Of course, they're still doing it with mortgages and medical debt and auto loans and credit cards and so on and so forth, but our focus for the moment is going to be the student loans. With banks giving loans to everyone at whatever inflated price the colleges and universities demand, all with the promise that you're guaranteed the paycheck to pay it off whether the job market actually agrees with that statement, because it's not going to bother the banks. It's not going to be the bank's problem for very long. They don't care if you'll actually be able to pay them back, so long as they get a loan that they can quickly sell off to Wall Street for a quick buck. Because of all this, if the government turns around and says these loans don't exist anymore, they set off another cascading failure of this broken system. And us everyday people get to pay the price for the bank's stupidity again. They could print more money and start to pay them off themselves. But we're already seeing massive inflation. And thanks to how much money printing has been going on and how it works, all that does is technically move the debt around, not actually eliminate it. See treasury bonds for how money printing works in the United States. And hey, maybe I'll do a deep dive on those. But this video is dense enough as it is. They could also just let them fail. But then they have two choices. Do another bailout. The first one was the single most universally, publicly hated thing the government ever did, and would still involve printing, just maybe not as much. Or do what they should have done and let the economy crumple, break up the monopolies like they should have the first time, and focus on helping the little people. This would be devastating and might not even have the long-term repair that would have come with it if they had done it the first time in '08, because they changed the rules. Now, the banks have the access to something called a bail-in, where they can lock and empty their own depositors' accounts, because you're no longer a depositor, you're a creditor, and use your money to pay the debts. And the FDIC will not cover the losses because they are the executor of this system. And again, that's something for a whole other thing, but that's the short version. So, at the end, the banks take everything from their customers to save themselves and probably collapse anyways, while the CEOs do what they did last time and take the money and run. Personally, what I would do is very, very slow, but would hopefully fix the system. Mix buying the slabs for direct forgiveness and taking on default payments by actually allowing people to have their loans discharged. It'd be a very slow process, since they wouldn't be able to take them all on at once. But something is better than nothing. Next is the big one, though. Tell the banks that they are required to make the colleges justify the prices if they want to offer the federal student loans, and investigate existing loans. Whenever they find unjustifiable expenses in pricing, make the colleges pay it back. This will take a massive chunk of the debt out of the equation and drastically cut back on new loan debt. Colleges are still free to charge whatever they want, but people will be slower to jump into inflated prices if they can't get a loan for it all, because you just can't, the college just can't justify charging as much. Thus, the only people who will pay the inflated prices will be people who are rich enough to pay for it out of pocket, or who choose to ignore all these warning flags and go get a private loan. At least some colleges would have to reduce their prices in order to remain competitive. It's hardly a perfect plan, and it means fixing the problem would be very slow going, but it'd at least be a longer term fix that would place some responsibility on the colleges and loan services to fix their broken system and help cover the costs inflicted on unsuspecting students. Plus, it would circumvent the disaster that Wall Street has set up. And having said that, if someone does figure out how to do mass student loan forgiveness without crashing the economy or taxing us into oblivion to force us to pay for it, I'm not going to complain. I just find it very difficult to see how to make it work with everything I just told you. And that's about it for this video. We've got this whole buggered up system that Wall Street has gotten us into, again, and that's why, as nice as it is to listen to politicians promise they'll snap their fingers and disappear our debt, it's probably not going to happen without some very drastic measures. Again, I welcome being proven wrong. I just can't see how to make it work at this time. Thank you for your time, and I hope this video has been helpful and not just depressing, though I'm sure it's plenty of that too. Please check out the link in the description for the hub to all my pages for streams, videos, socials, and how to support the channel. And please note that though I may respond to you, I will never link or offer contacts in the comments. Given that this is a financial video, I'm sure the scammers will show up. So please be very wary of anyone pretending to be me, peddling promises of getting rich down there. Thank you again, and I'll see you in my next video or stream.